Hello, I'm Anastasia Amoroso, and welcome to Beyond 60/40. On this show, we do a deep dive into the alternative investment space, share industry leader insights, as well as discuss the latest innovations in technology. So to kick off our first episode of 2024, I'll share the one thing that caught my attention this week in private markets. Then I will be joined by JP Morgan Asset Management Global Co-Head of the Private Equity Group, Ashmi Mehrotra. And finally, we will introduce a new segment to the show, Your Question of the Month. Let's get to it. In today's Market Pulse Snapshot, the one thing I'm focused on is the private equity exit environment and whether 2024 will be the year we see a rebound in exit activity. Throughout the latter part of 2023, pressure has seemingly been building for fund managers to act on a backlog of maturing and delayed company exits. For example, in 2023, there was an estimated 1,100 PE-backed companies worth a combined value of $234 billion that either exited or were announced to be exited. But that marks a 17% decline from 2022 levels and 16% below the 10-year average. Now, financial services and healthcare sectors, it's what's led this decline, with both sectors collectively accounting for 14% of all exits versus 19% historically over the past 10 years. Now, we know the reasons: persistent inflation, elevated interest rates, and unfavorable valuation trends. That was the sluggish macro backdrop that led many GPs to opt out and hold on to their assets for longer rather than take them to market at adverse terms. As a result, the average hold time for current PE investments has been extended to 4.2 years, surpassing the prior 5-year average of 3.8. Now, that probably does not seem like that's all that significant, and it's only marginal, but a number of deals that got done in the last 5 years are now nearing their natural exit timeline. And the delay in exits also means that LPs are not getting distributions that they could in turn commit to a new fund. So all of this suggests to us that GPs will be increasingly more motivated to exit as the year progresses, assuming the right conditions exist. Now, what are these right conditions that could drive GPs towards realizing more exits in 2024? Well, for starters, is the green shoots that have begun to emerge with the macroeconomic backdrop continuing to point towards a soft landing, and we do have a number of central banks that are poised to ease policy this year. All of that should in turn support valuations and give GPs more confidence in those. Indeed, public market valuations have reset significantly higher throughout 2023, and that perhaps suggests that private market valuations could follow a similar path over the next couple of quarters, and that could provide a better backdrop for IPOs and M&A transactions. Now, all of these dynamics together can make 2024 a more promising year for a rebound in private equity exit activity. And that's your one thing in private markets this week.